Hello, good morning, good afternoon, or happy lunchtime, depending where in the world you are today. Thank you for joining us for our webinar this lunchtime in the UK. So today, our topic will be real estate and the development of skyscrapers. So particularly looking at examples in London, but relevant for all major cities. So my name is Steve. I'm Steve Brewster. I'm an Associate Director in the Executive Education arm of the Saïd Business School at the University of Oxford. And we have a series of webinars ongoing across a range of topics to spread some of the experience and expertise which we have at the business school, and also to support and raise awareness of our executive education programs as well. Today, the webinar will really be in support of our new executive program on real estate, the Oxford Real Estate Program, which will run in June of this year for the first time. This is a program that has been in planning for some time with the program director, Professor Andrew Baum, who we'll hear from in a few moments, and also working with a number of leading industry professionals from across the globe, but also from London. So our guest on the webinar today is Yair, Ginor, who will also be involved in the teaching of that executive program. So the format for today is that this webinar is scheduled for an hour. We will probably close slightly ahead of that. So I will do some introductory remarks for a couple of moments. Then I will hand over to Professor Andrew Baum, who will have a conversation with Yair Ginor from Lipton Rogers around questions with the challenges and opportunities faced when developing major projects in complex cities. That conversation will probably be 25 minutes or so. We would encourage you to ask questions. And the way to do that is that on your screen you should see a dialog box. It's probably on the right hand side, and in there is a question panel. So please feel free to type in your questions at any time as we go through, as they occur to you, but we will save those until the end of the main conversation, and then have 15 minutes or so of questions at that point. So please do type those into the question dialog box as we go through, and then I'll do a call for questions at the end. Because we have quite a significant number of people on the webinar, we do keep all the lines muted apart from the main speakers to get a clean signal. So you will need to type in any questions rather than ask them out loud, just to make that clear. Okay, so I'll do some brief introductions. So the Oxford Real Estate Program is a brand new program which we're launching for the executive market at the Saïd Business School in Oxford. It is designed for professionals who are already working in the area. So we will have people from real estate development firms, we have some investors, we have some architects, we have some consultants signed up, so quite a broad mix. Generally, we are looking at people who have 10, 20 and more years of professional experience, either directly in real estate or in finance or investment or law in related fields. The program is really a strategy program based around the real estate sector. So we will be looking at the opportunities, threats and forces acting on the real estate sector now and coming in over the next 5 to 10 years to gain an understanding of what the real estate sector might look like in 10 years' time, and then to build some business and investment propositions and plans to address that landscape. So participants will be learning with Professor Baum, Yair, and some of our other leading finance faculty across the business school to get their latest in terms of their teaching and their research, but also to feed directly into an investment plan and proposition, which you will then present to a panel of investors towards the end of the week. So we hope that some of those investments will go forwards, and certainly in doing those exercises you'll be very well prepared, both to prepare your own investment plans for the future, or knowing what questions to really delve into when people are presenting them to you. To introduce our speakers for today, the main speaker and host will be Professor Andrew Baum. So Professor Baum is the Programme Director of the Real Estate Programme in Oxford and a visiting Professor of Management Practice at the Saïd Business School. Andrew has a long history of academia and industry. So he has degrees of BSc, MPhil and a PhD around land economics, real estate and finance. He has been teaching at Cambridge, at Oxford, at Reading for the last decade and beyond, and at the same time has been very much involved in the business world. So certainly an academic who with one foot very firmly planted in industry and in day-to-day business. So both of those arms are equally important in executive programs like this. Today, Professor Baum will be in conversation with Yair Ginor. So Yair is a partner and a director at Lipton Rogers Developments. So Lipton Rogers are a London-based development firm, particularly concentrating on large and complex projects around London, but also further afield as well. So Yair and his partners have worked on some of the leading projects across the London skyline over recent years, and will be working on some more significant ones over the coming 5 to 10 years, which we may hear a little bit more about later on. So with those introductions made, perhaps now I will hand over to you, Andrew, and you can carry on any further introductions and start the conversation with Yair.
Thanks a lot, Steve. Could we move on to the next slide? There we go. Okay, so the executive program is built around 6 challenges to do with real estate investment, real estate finance, the real estate occupier markets, and also the real estate development market. And that's where we're focusing today. I'm delighted that we're with Yair, who is a really good speaker. We have a really good time in the classroom with Yair. And if we move on to the next slide, we can start off with the questions that I'm going to ask him. So the first thing, Yair, it's been in the press that you're going to be involved in building about the biggest skyscraper in London in the next 5 years, which we may talk about later on. Where does the idea for a development come from? Is it usually a piece of land looking for a use, or is it a site looking for an idea, or is it the other way around? How do these things get started?
Good afternoon, thanks. It's a very good question. You put me right on the spot here. The answer is probably there's a bit of both, which I know is kind of diplomatic and boring, but I'll explain what I mean. If you own a piece of land, then of course you'll be looking for the best use, the most expansive, or the tallest, the largest, the most valuable use for that piece of land. That is generally not where I come from as a developer. As a developer, I don't have a bank of sites that I'm sitting on waiting to develop. Rather, I'm looking for opportunities in the market of sites that are either on the market or about to come to the market, and where there's some innovation and some out-of-the-box thinking required about what can be made with that site. Normally when a site comes to the market, it is heavily marketed, especially in the current market we're in at the moment. The owners of the land will have already appointed agents that will have advised them on the uses and the values, and all the market is going to be bidding on that basis. So as a developer, if I want to secure the site, I need to think harder about what can the site take, or maybe think about uses that the owners or their agents have not thought about, or be willing to take a much more bullish view on values, because frankly, if I don't do that, I will not be able to win the site.
There's a couple of points I'd like to pursue in there, Yair. One is to do with getting what you can on the site. Clearly, the more intense the development, the greater the amount of floor area you can build on a piece of land, the more you can afford to pay for the site, and the more likely you are to win the development project.
That's right.
There is a difference, though, isn't there, between a plan-based system where you know what you can build on a site, and a rules-based system, and systems where there is very little planning at all. Perhaps we could just talk about that for a while, and your experience of working in the London market, and how that compares to other markets around the world in terms of the certainty about what you can get on the site.
Yeah, absolutely. Just to explain a bit these two terms which you just mentioned. So a plan-based system is, for example, what we have in Manhattan, in New York, where it has been dictated and is now engraved in the plan what you can and can't do on each plot of land in the city. So each plot, when you buy it, you already know whether it's designated for offices or residential use or any other use. Moreover, you know when you buy the site how many floors and what is you can build on the site, what is known as a plot ratio. So what is the ratio between the volume on the site and the area of the site itself. So in that sense, when you buy the site, you know pretty much exactly what you can build on it. In London, by contrast, we have a rule-based system which is designed to be more flexible and more responsive, but in reality means that there are no predetermined uses or plot ratios, albeit that we do have local planning policies. And the practice means that every time I want to develop a site, I need to come up with a design that will win the hearts and minds of the planners, the local communities, the authorities, the transport authorities, the park authorities, a great number of consultees that I will need to liaise with, consult with, and convince that the particular project that I'm proposing is right for the area, is the right use, it's the right height, it's the right design, which makes my life very interesting, but also means that the risk with regards to gaining the planning consent is that much higher.
Okay, so which system would you rather work with?
It's a very interesting question. I think that, you know, if you could choose, which of course you can't, because this is just one of the realities of operating in a certain market. I think that as an investor, if you could choose, you probably go for a plan-based system because you have more certainty. But of course, the flip side of that is if you have lower risk, you can expect lower returns as well. If you like a high-risk environment as an investor, and indeed as a developer, then I think you would be more attracted to the London system. Certainly, as a professional developer, rather than an investor, my role is to help my investors solve all these problems, jump through all these hoops, and overcome all the many obstacles that we face in bringing a project to life. If it was very easy, then anyone could do it, and I'd be out of business.
Right. Okay. We'll talk about how you get rewarded later on here, maybe. In your opening comments, you also mentioned the point about deciding how much you're going to pay, and you talked about the current market being very hot. And the question then arises, the extent to which you can project the market forwards in deciding how much you can pay for a piece of land. I mean, clearly, if rents have been rising for 5 years and there seems to be a strong economy and a shortage of development projects, then it must be very tempting to project forwards the future value of the developments that you are going to be building, and then bidding more for the sites than other people might be doing on the basis of those projections. Is that a temptation? Is it something that you can avoid? Is it a discipline that you can impose or shouldn't impose?
You make some very, very valid points, which I'll try to address in some shape or form, and I know I will not be successful because this calls for a 2-hour discussion, not a 5-second discussion. I think we can safely say that to some degree we're all doing that. So we are all projecting forward value, even though by the book we shouldn't be doing that, because we should always only base our bids on current values and current costs. We have the Royal Institute of Chartered Surveyor here in the UK, and they publish guidelines on how you do valuations, how you do site assessment and project feasibility, and the rules clearly say that you should do it on the basis of current values and costs.
But that's irrelevant, isn't it?
But to some degree it's irrelevant because, and certainly in the current market, if we're always going to be cautious, we would never be able to secure even a single site. Yeah. So to some degree we're all doing that, albeit that we can mask it in different terms. So one investor will say that he's willing to project higher values. Another investor will say, no, I'm keeping to the same values, but actually my cost of capital is lower. Of course, the net result at the bottom line is going to be exactly the same. So you can call it by different names. The reality is, if you want to win a site in a competitive environment, you have to be very bullish on your values. Of course, as a developer, and I know you want to ask me about that later, but I'm going to give it something away now. As a developer whose remuneration model is based on achieving outstanding results, if I'm committing to extremely high values and very low cost right at the outset, at the point of buying the site, then there's very little scope for me to deliver outstanding results over and beyond that, which is what I ought to be doing. Which is a problem for me. But I just wanted to add another comment and say that we're very fortunate to be operating in London, where the market is extremely transparent and knowledgeable, and certainly compared with some markets, we have a huge amount of information available not only to us, but to anyone, really. There are extremely professional real estate advisory companies operating in the market, which I will not name because I'll miss some and I'll be punished for that. But the information is available out there with very good projections over the next few years, so anyone who wants to can have access to this information and use that in bidding for sites.
Okay. Let's talk a bit more about money, and perhaps we can move on to the next slide, Steve. So, where does the money come from? An agent, a London agent, has come to you that he's given you the information that there is a site likely to come onto the market that you're going to be asked to bid for. How do you locate the capital? And what sort of capital is it? Is it debt? Is it equity? Who are the people who put the money into these things? And just to clarify, Lipton Rogers is not a bank. It's not not a pot of money that can simply go out and buy these sites. You need to get finance from somewhere else.
That's right. Even though we do sometimes participate as investors in our own right in the project, just to make sure that that there's an alignment of interest between us and our investors. But you're right, for the most part we are providing a professional service in helping investors to get into the market and to overcome the many challenges which any project faces. I'm not going to talk specifically about our business model in Lipton Rogers because obviously every platform has a slightly different business model. Some raise funds in advance, others raise funds on a project-by-project basis. But what I will say is that London is a huge magnet for capital. I'm not saying something that people have not heard before, but we see capital coming into London from literally every corner of the world and in every shape or form, both debt and equity, all positions in the capital structure. And the reason that all these investors come to London is not necessarily because they think they can achieve superior returns here, but because they see that as a very good, safe investment. It is highly liquid because everyone is already here. There's a huge amount of stock of all kinds, be it residential product, office, leisure, and all the other special types of real estate product. Sorry, you wanted to?
Well, I was going to say we can argue about whether it's a very safe investment, and on the executive program we will argue that one. I think well, it's been a particularly volatile market, and it's possible to lose money in this market.
Fair enough, of course, but at least it is transparent. It's not corrupt. It's governed by a rule of law. These are laws that are recognized around the globe. Yeah. The information is out there. It is really not an opaque market, so anyone, as I mentioned before, can go on a website and find out trends and the values and and the costs. And also, I think it's important to mention that the softer sides to it. I mean, people like coming to London, which is why they like investing in London. They feel at home here. A lot of our investors, whether they are based in Asia or the Middle East or in North America, have done business in London before. A lot of them have studied in London or live here.
So the same would be true of New York, and there are other places around the world.
But there are, but very few of them.
Okay. So you have a potential equity investor. It's your job to know where these investors are, and it's your job to use agents who know where these investors are. And you locate an investor who wants to provide equity capital into a project. You also presumably have contact in the banking system, so that if you need to procure debt, you know where to go.
Yes.
Let's say you've won the bid for. Well, let's talk about the process actually. So you've found a site that you're interested in. You know roughly what scheme you want to build on it. You come up with an idea about what you can afford to pay for the land. Is that the right order?
Yes, although it's more complicated than the way you portray it. But yes, it takes some weeks of really hard work to get to that point. But yes, generally speaking, it's true.
At what point then do you locate the equity partner in that process?
As early as possible, especially in the current market. If a site is about to come to the market, it's usually a matter of only a few weeks before, between the very first announcement that the site is going to be available and the deal being closed. So I have to act very, very fast. And also, investors like to be kept in the loop at all times. So it's no good me doing a huge amount of work and coming up with a scheme, finding professional advisors, only to then find out after weeks of work that no investor is interested in that particular project. Now, what you alluded to is that part of developing relationships with investors is knowing everything there is to know about their requirements. What sort of deals they like. Do they like income-producing deals, or do they like development deals? Do they like the sort of deals that produce some income over the medium term but have long-term development potential? What is the lot size they prefer? Is it 50 million or 250 million? What degree of risk? What locations? And so on and so forth. So it's my responsibility to know all of that stuff about my investors. But at the same time, there are things I just do not know. It's very possible that I think that there's a perfect deal for specific investors, but as it happens, they closed recently a deal on a similar project in, say, New York, for example, which means that at the moment they're not interested in doing any further deals. So I will not be able to know all of that until I try.
So you've located a site, you've lined up the right equity partner.
Mm-hmm.
Do you buy the land 100% cash when you go in and secure the site? How does that normally happen?
Well, of course, I'd rather not. From a pure IRR perspective, the longer I can delay the payment for the land, the better returns the project will show. So that's a no-brainer. But in the current market, and excuse me for repeating myself a bit, land owners and vendors will have absolutely no reason to defer receipts for the land, because they know that if I don't do the deal with them, someone else will. They have a very strong position at the moment, which means that things like an option on the land, whereby you pay a small sum and you only purchase the land in full after, for example, a certain period of time, or other arrangements like conditional purchase of the land after, for example, you've achieved planning permission. All of these arrangements, which are designed in a way to protect me as the purchaser, are perhaps things that we will see the next time the market drops. But at the moment, what we see is quite the reverse. So not only do vendors want to see full payment for the land on day one, but they also want, on top of that, to have a proportion of the profit on the back end.
Wow. Yeah. Okay. So you buy the land up front, and then you have to pay something else later down the road based on the profit that you make.
That's right.
When you buy the land, are you likely to use any debt, or is that going to be equity?
It's, to be honest with you, it's probably a question of speed and finding the right investors. So what would be a typical case is you find an investor that can, if they wanted to, purchase the land with 100% equity. That allows you speed to market, and it gives confidence to the vendor that you will actually follow through with the deal. Because I should say, when we're bidding for sites, the vendor is looking not only at the price but also at the reliability of the counterparty, because they too don't want to find themselves having barked up the wrong tree and wasting a lot of time, only to then find out that the purchaser can't perform. So it's best for me to go with an equity partner that's good and large and strong enough to purchase the deal 100% equity, and if they then later on, which could be immediately after purchasing the site, want to take, say, 50% debt on that, then of course we can do that.
Right. Okay. And then, are banks interested in putting debt into pure land? Will they do that these days?
You're asking because obviously it's quite risky endeavor.
Yeah.
Yeah. Yes, you can find banks to do that.
Okay. Yeah, that's fine. That's fine. Then as the project then continues, you work up your detailed planning consent. You go through the negotiations with the zoning and planning authorities, and then you start building. Who funds the construction then? How do you fund the price of the building contracts as they go through the 3-4 year process?
Again, it's on a case-by-case basis. So, we've completed a very, very large deal recently with a consortium of international investors who have committed to doing the whole scheme with 100% equity throughout, not only the land purchase but the development itself. Could they have obtained debt? Of course they could, but they didn't want to, because their particular requirements with regards to their risk profile dictated that they did equity alone, and they were happy with the returns as they were. They didn't need particularly to maximize those returns beyond what they showed at the moment. Other investors will, of course, take a very different view. So, for example, you can see one investor funding the purchase of the site and the whole professional team fees up to the point of achieving planning, and is then either selling to another investor or selling a part of the vehicle to another investor, or raising debt at that point, all of which designed to enhance returns. So it's really up for grabs.
Okay, let's move on to the next slide, Steve. We're going to now talk about the project management and how the scheme is managed. And just to clarify again, a developer like Lipton Rogers is not a construction company.
That's right.
There may be people on the call who are working for combined development construction companies, but we're talking here to a developer, an advisor who does not have a construction arm. So how do you relate then? How do you get the thing built, and who's responsible for that day-to-day management?
The short answer is that we will be responsible for that, in the sense that we are the conduit between the investor and the project. The more elaborate answer is that before you even get to building it, which I know a lot of people think about development as building, in fact, there could be a very, very long period of time between purchasing the site and starting to build. Indeed, I've been involved in one project where we spent 5 years from purchasing the site just to getting the planning permission, and it will probably be another 1.5 years as a minimum before we start building. So building for me is the easy part, because it means that by that point a lot of the major risks that the project is facing have been de-risked and have gone away. Things like securing the planning permission, as you mentioned, dealing with all the neighbors around the site that will have various rights and with which I will need to negotiate various agreements, for example, to access their land if I want to use that as a means to getting with construction traffic to my site, or maybe I'm going to have to oversail their land with the cranes, which means that I need to get a license from them to do that.
Maybe you have an underground railway passing under the site.
For example, you can have underground assets that you will need to negotiate with the transport authorities, the right to build over. So these are just a handful of examples of the many things you have to deal with way before you get to start building. And it will be the role of the developer as the key point that is overseeing the whole of the project and is employing the whole of the professional team and ultimately the contractor to make sure that all of that goes to plan and to report back to the investor.
And you will negotiate a fixed price contract with a single builder or with a series of construction companies doing different things on site?
The way we normally do it is we will engage early on with a contractor. We will try and bring them as early as possible to help us make sure that as the building is being developed and designed, that we are pursuing a design that is very efficient, that is cost effective, and will be quick to build. After which point we will hold an open tender. Normally it makes sense for us to have one main contractor with a very strong balance sheet that we can enter into a contract with on a fixed sum basis, and it will be that main contractor that will subcontract with specialists, but at that point it will be the contractor's risk as opposed to the developer's.
Right. So at that point you would say that there is such a thing as a true fixed price contract, so you can pass all of the construction cost risk onto a contractor.
I'm hesitating for a second because the answer, unfortunately, is yes and no. It's yes in the sense that you can enter into a contract with a contractor on a fixed sum basis. Yes, absolutely, you can do that, and we are doing that. In fact, it will be very foolish not to do that because then we are exposed to the very high risks of capacity in the construction market, material inflation, and so on and so forth. The reason you cannot insure against any cost risk is because in many cases you as a developer will want to change the scheme after it has already started. Now, you know, the textbooks will tell us that we should never do that because at that point costs are starting to go up, and because the contractor can then rightfully ask for more fees and you've thrown away your fixed sum. But the counter argument is that it's taking so long to develop a project, and the last thing you want to do is develop the wrong product into the wrong market. So it's not inconceivable that after you've designed the building, or indeed after you started building it, there will be external changes in the market that will force you to make various changes in order to make the building more attractive to the market, at which point you as the developer will want to open the contract with the contractor and negotiate it afresh.
Yeah. Okay, coming towards the end now, if we just move on to the last slide that we have here. Clearly there are risks and rewards in all of your work here, and you know, from my experience, I have to say this is the riskiest and potentially the most rewarding aspect of real estate investment without any limitation on what I said. So somebody could lose a lot of money, somebody could make a lot of money. How do the rewards get split between the contractor, the developer, the investor, the bank? You know, how does the profit get split, and who is really taking the risk of all of this going wrong? And then finally, on the same question, what drives the profit? Is it skill or is it luck?
You know what I'm going to say to that. Let me answer the first question first. In a way, everyone involved in the project is taking a risk. But the risks are not evenly spread. So the investor will take the lion's share of the financial risk because it's the investor's money, and development, especially in London, can be extremely expensive. So we're talking about a lot of money, which is why they take also the lion's share of the profit, which makes perfect sense. This is why most of the rich list on the property side is populated by people who made their money in doing development as opposed to passive investment. Of course, all the people who have lost a lot of money you don't hear about because they disappeared from the market. So
they were also developers.
Yes, that's true. So it makes for a very imbalanced view. But certainly the investor will have the lion's share of the financial risk, but others will take risks as well. The developer, for example, in many cases is expected to co-invest alongside the investor. Not so much because the investor wants to diversify the risk, but it's more that they want to make sure that the developer remains focused and alert and is not going to be cavalier with the money just because they're not committed to it. So there's an element of co-invest, but even if you take the co-investment out of the equation altogether, the developer is the one that puts the most time and effort and knowledge into the project. So there's certainly the expectation that the rewards will be there in the end, but again, depending on the circumstances of the particular project, that may not be the case.
So your model may be a fixed fee plus some sort of profit share at the end of the day.
That is right. That's the base model, and of course we're ignoring co-investment at the moment because co-investment will be treated as any other investor. So yes, there is a preferred return, if you like, to the developer. But I should mention that other members of the development team or the professional team are at risk as well. I mean, it's not inconceivable at all for the architects or for the contractors to be making a loss on a project, even though in theory their fees should be agreed and fixed in advance. The reason is that, as it happens sometimes, those professionals end up spending far more time on a project than they intended to and budgeted for originally.
Yeah. And finally, Yair, is when things go well, is it luck or is it skill?
It's a combination of the two. I'd be lying if I pretended it's only skill, because you know, even with the best of skill, you cannot turn around the general economic trend. If the whole market is going in a certain direction, then it would be extremely rare, if at all possible, for a specific development to go the other way. Having said that, if you look at the downturn, the recent downturn that we saw in the markets, which we're now coming out of, it's noteworthy that even in the deepest part of the recession, there are still buildings being sold and let. And I would argue that it's the best buildings that will continue to trade even in the depth of a recession. Now, what makes a building the best building in its location or its class, that I would argue has a lot to do with the skill of the developer.
So what you're saying is that if you do your job really well, you can reduce the risk of all parties and you can maximize the profit for all parties as well, whatever the market.
Absolutely, which is why I think developers are rightly entitled to their profit share.
Right, thanks, Yair. Okay, Steve, that's completed the formal part of the discussion. Do we have any questions online, or is there anything else you'd like to add in?
Yes, thank you, Andrew. Thank you, Yair. Yeah, we do have a few questions actually. So to start off, I guess, on one of the topics which we've just been mentioning about the contractors and their fees, we have a question from Nasir Ahmed, who asks, what happens when a contractor's fees escalate throughout the project beyond those that were initially agreed and projected at the outset?
Well, I guess it goes back to Andrew's question about, can we actually have a fixed sum contract, to which my answer was yes, absolutely. If we have entered into a contract with a contractor and the contract stipulates clearly what the price is, and indeed the contract has appended to it a set of drawings, which is what we are intending to build, and as long as the designs have not changed, then the fixed sum should still hold. Again, assuming that we have decent construction lawyers that manage to not make a complete mess of the contract. After that point, it becomes the contractor's risk, and indeed the contractor's problem, if, for example, materials start going up in price, or if there's a shortage of labor in a specific sub-market, which means that the cost of the labor will go up. The contractor is then at risk. Of course, it almost goes without saying that when we negotiate the fixed price, the contractor is taking a view on all these risks, which he will be in a much better position to assess than any developer, because he will be much closer to the market. He will try and estimate what are the chances of costs going up or capacity in the market going down, etc. He will build all of those assumptions into his model, and he will charge a fee accordingly. So the fixed price includes the contractor's fee, the contractor's profit, and it is that profit that serves as a buffer in case things start going wrong.
Okay. So it seems to me that the developers can make mistakes by not agreeing fixed price contracts. In other words, by not having complete plans before they start the project, and so experiences that I've had have included cost overruns where contracts have not been completed in advance, and therefore you don't have a fixed price contract. What can you do about that? There's very little you can do about that in my experience. It's a very difficult situation to get into, because once you've sunk the capital, you're committed to the building out of the scheme, and you may have very little choice about which contractors you use at that point. So it's a dangerous situation. We have talked about using derivatives to hedge this sort of risk, but it's an extremely difficult thing to achieve. Sorry, we'll go on to the next question, Steve.
Yeah, sure. So a question from Dan Martin, who's been asking about the design of the building. So the question is, how important is the actual design of the building? Is it simply about maximizing square footage on a particular size plot?
The design of a building is of extreme importance, and I'm not saying that only because I was trained originally as an architect, and I care a lot about how a building looks. A well-designed building, and this goes to some degree to the point that we just discussed about the value that developers create. A well-designed building will be attractive to the market, will be able to achieve rents or values over and above the competition, will be able to let or sell quicker than the competition. And the flip side of that is that an unsuccessfully designed building will just not let. And we've, I mean, I'm not going to name names, but we have ample examples of both. I sat on a panel recently about tall buildings in London, and one architect was going on about a particular tower, which again I will not name, and how beautiful and how amazing and how great that building was. And then
this could be the Shard, by the way.
I'm not saying anything. I'm not saying anything. And then the comment back from one of the panel members was, in fact, if a building is not let, if tenants don't want to be in that building, then you can like it all you like from an aesthetic point of view, but it's not a successful building, and it's certainly not a successful investment.
That's right. I mean, it's an easy question to answer in many ways. A well-designed building will let for a higher rent. It will let more quickly. There'll be less rent-free period at the front end. It will sell on a bigger multiple, and it will perform better as an investment for the person who buys it at the end of the day as well. So in all respects, there's no doubt that good design creates value.
Okay, thank you. In the interest of time, I think that we'll save other questions for another time. So questions around the limits on sizes or numbers of skyscrapers and so on. So let's save those for the executive program itself, or perhaps for a future webinar on a future date. So I will summarize a little bit about the executive program. But first of all, before I do that, I want to thank you, Yair, for your time today and for sharing that information and those insights as far as you can in a very succinct and clear way. So thank you.
Thank you. It's a pleasure.
And also thank you to you, Andrew Baum, for chairing that for us and leading that conversation. That was excellent. Thank you.
Thank you.
So to recap then on the executive program itself, that will be directed by Andrew and will be taught by him in conjunction with Yair. Ginor will come in to talk in some more detail about some of the subjects which we've touched on today in a structured way. We will also have Professor Ludovic Philippou, who is with our Private Equity Institute here at Oxford, who will talk in more detail about some of the capital structures and opportunities and threats that can bring as well, particularly from the private equity side, but across the capital structure space. The program is really a unique opportunity to build global best practice knowledge. So, and to talk to some of the executives which we've heard from today, but also with a peer network from around the world. So we have participants signed up from across Europe, Middle East, from the US, from China, and Hong Kong in particular, and we're also working on a number of others as well, who are very much involved in the types of projects which we have been talking about today. So it's a very good opportunity to share your experience with those people from different markets to find out what the trends are there, how things are playing out, and then to use those to work out and design and refine your own real estate investment strategies, which you'll then present to a panel through the week. So the program runs in Oxford in June. The dates are the 22nd to the 25th of June. The price is on the screen now, £4,950. We have a full listing of the program on the website, which you can also see on the screen in front of you at sbs.oxford.edu/OREP for Oxford Real Estate Programme. A little summary really about who the program is designed for. So as we have said, people who are already at MD, VP level, people who are qualified as professionals in this space and really looking for an opportunity to think about their future strategies. People working in related professional service firms who are looking for a broader view of what's happening in the real estate sector. And we also will have some real estate owners involved as well. The way that we teach, and we've picked up on this a little bit today, is that we like to integrate the latest research and academic thoughts coming out of our research at the university, which is primarily research-led institution, very much with industry leaders. So to work out what the data tells us about different trends and performance ratios and so on, with very much what's happening on the ground in the markets and in the city. We will have some talk sessions, but all of those will be very much a led discussion. So we would expect and encourage all participants to raise questions throughout, to share their experience, to discuss their ideas with the presenters, and sometimes to debate counterpoints with them that we can all learn from. So at the end of the program, they are engaged, equipped, and really enabled to build their investment strategies for them and their organisations as we go forward over the next 10 years. The final thing to say, we've already talked a little bit about the network of people who will be on the program, is that participants on the program are also invited to join the Oxford Business Alumni Network, people who have studied through the business school and across the wider university, who have a particular interest in business and in real estate in particular. Thank you very much again for taking the time to join us on our webinar today. We will send you an email to give you my contact details direct following up from this. If you do have questions or anything that comes to mind right now, then please do send me an email on steve.brewster@sbs.oxacuk, or give me a call on my number there. We have recorded the webinar today, and that will also be circulated in an email shortly. So that just leaves me to thank you once again for coming, and thank you again to Professor Andrew Baum and to Yair. Ginor, thank you very much for your time, and look forward to speaking to you again soon.